In this video, we're going to primarily concentrate on bond risk. In particular, we're going to look at interest rate changes, and we'll also discuss a little bit about default risk. But let's first start talking about interest rate changes. As you're probably aware, there is an inverse relationship between interest rates and bond prices. So that is, as interest rates go up, bond yields rise because investors want to be paid more because interest is a risk to bondholders. If bond yields go up in order to provide higher yields in the future, that means current bond prices for purchase are falling. So as interest rates go up, bond prices fall. And what we'd like to do is to understand a little bit about how sensitive bonds are to changing interest rates. Interest rates change daily, so we like to have some perspective. And what provides that perspective is a statistic that's called duration. It measures the sensitivity of a bond's price to changes in interest rates. And of course, when interest rates go up, bond prices go down. So duration measures this inverse relationship. So bonds with low durations are going to be less sensitive to rate changes than bonds with higher durations. So if we look at interest rate in general, there are really two parts to it. The part that we've always been talking about, and quite frankly, the part that duration helps us measure, is something called price risk. Price risk is the change in prices that occurs when interest rates change. So long-term bonds will have more price risk than short-term bonds, since there's this great period of time for this change in interest to impact the bonds. Low coupon rate bonds will also have more price risk than higher coupon bonds. Again, the reason for this change in price now, we've already talked about it. So when interest rates go up, prices go down. And as an investor, you're obviously concerned about the wealth of your portfolio. So let's go to the next step, which is also the other part of interest rate risk. We refer to that as reinvestment rate risk. Reinvestment rate risk talks about the uncertainty of future returns of reinvested coupons. So if interest rates go up today, when you get a coupon and you reinvest that in a bond, you should be able to reinvest that at a higher return because interest rates in the economy have gone up. So short-term bonds will have more reinvestment rate risk than long-term bonds. And high coupon bonds have more reinvestment rate risk than low coupon bonds. So in the end, why is this important? Well, if you're thinking about an entity that is tied to interest rates, specifically talking about a bank, this can be critical with respect to the value of their assets and liabilities. So if you have an asset and interest rates change, it changes the same way as we've been talking about interest rate risk. If interest rates go up, the value of assets that are tied to interest rates go down. What then happens on the other side to liabilities? Well, now since you own those, those will actually go in the opposite direction. So we have these assets and liabilities that are negatively related. So how can we adjust, or how can we, using an investment term, how can we hedge against this risk of interest rates changing? So here's an example where this might become important. Let's assume that in 10 years, we're going to owe $1 million. So we want to save enough money every year for the next 10 years to get $1 million. Well, we can do that by saving $100,000 a year and just let that ride. Of course, it will earn a return. So in the end, we'll actually have more than $1 million. On the other hand, we could put that into some other kind of an investment where the cash flows might be uncertain, and then and by the time we get to 10 years, we wouldn't have enough money. We wouldn't have $1 million. So the process of, in quotes, hedging or protecting our investments and our strategy is something called immunization. So this is very important for banks, pension funds, insurance companies. Any business that is directly tied to interest is very concerned about interest rate risk. Um, so the alternative then obviously is just to maybe invest too much money. Of course, we could use that money in production or something else to make a greater return than what we have with respect to our um, excuse me, our strategy. So, immunization is this tool that will help us guarantee that our wealth will not um, be unfairly or unfavorably impacted when interest rates change. And just to go back one slide before, if you notice these things, as if interest rates go up, bond prices go down. So when interest rates go up, price risk negatively affects our values or our wealth. Reinvestment rate risk, though, is in the future. So when interest rates go up, future cash flows we invested at a higher rate of return. So that's a positive thing. So every time interest changes, there are two things that happen every single time, one of which is positive, one of which is negative. So the impact or the influence that immunization has is that it equates those positive and negative influences for bonds. So Disney here had $1 billion 50-year bond that it was selling. The bonds had a 3.5% coupon, and the yield to maturity was 4.2%. So again, if you think about this, what is the value of this bond? Right? If we have 50 years to go, you see here's the bond valuation worksheet, and this bond is worth $854. If the bond is selling for $850, the question is, what is its duration? Well, the duration here, we typically use this modified duration. The number is 21.55. By itself, that really doesn't mean anything. Technically, it is the break even or the payback period, if you will, for investing in a bond. So if you bought this bond today, in 21 and a half years, you roughly would have gotten all your money back. This duration, though, and this is just as a sidebar, this duration measures a straight line, but bond prices move in a curvilinear fashion. So this convexity is a measure of the curve. And that's a little bit more detailed than what we need for this particular application. But it does give a more accurate estimation of what's going to happen to value. So in this case, we also ask the question, if interest rates increase by 0.01%, and I see my example here is kind of confused, so I'm going to change this real quick because I can do those things. If it changes by 0.1%, which is right here, then the new price is going to go from $850 to $831. It's going to decrease by 2.1%. And again, I apologize, I have too many zeros here. What if the interest rates decreased by 0.05? Again, if it decreased by 0.05, this is a negative number. So, of course, you're going to see that the price is going to go up, and it will go from 850 to 859. And again, you can also see with convexity how it changes. We're only off about 30 cents there. We're off a little bit, only 8 cents there. So the convexity just gives us a more accurate version. It just takes into account the curvilinear nature of the changes in bond prices. So duration, again, is that statistic that measures the sensitivity to interest rates. If we think about corporate bonds in general, obviously they're issued by corporations. But what this introduces to us to then is credit risk. Up to this point, we've essentially been talking about government bonds. Government bonds have zero default risk. So obviously, with a corporation, there's a chance that the corporation will not pay us when we are owed money. So the yields of bonds that have credit risk will obviously be higher than those with default-free types of bonds or government bonds. So how does that affect price? If the risk is higher, you know the price is lower. So if you have a bond with credit risk, it will have a lower price than the default-free or the risk-free bond from maybe the government. So let's take a corporate bond and talk about the concept of certain default. Right? So if we're going to calculate the yield to maturity with something that has certain default, we have to change how we view the cash flows because it's not actual cash flows. We're looking at promised cash flows. And promised cash flows have the probability of not being paid. So again, we have to change our view of exactly what kind of cash flow we're looking at, and that will ultimately affect the return that we expect to receive. So here we have a $1,000 zero coupon bond, and let's say there's a 50% chance that it would repay its face value in full, but there's also a chance that they would default and you'd only receive $900. So the expected or the average would be 50% of 1,000 plus 50% of 900. So you'd expect to get $950. Now, because of that uncertainty, right, the discount rate has to be different from what it was because now there's a chance that you won't receive this cash. So the no risk of default discount rate on this type of bond, again, you get $1,000. The value would have been $968.18 at a 3.5% discount rate. Now the price of the bond now is going to change, right? The price is going to be $950, what you expect to get paid. Now we change the discount rate to 1.05. So now the new price is $903.90. So now what is the yield to maturity on this bond? Okay, if you calculate the yield to maturity, it just changed and now it's 10.63%. So if you look at these bonds, right, with a 50% chance of default, the yield is going to be 10.63%. When it was default free, the yield was 4%. And of course, the certain default, right, 15.56% is the yield if there was something that had a certainty of default. Again, the only real message I think that we want to get from this section is that when you incorporate risk, you have an impact on prices and returns. The capital world helps by measuring and addressing this credit risk, if you will. And how they do that with bonds is through credit ratings or through bond ratings. So this is a description of some sample bond ratings. Quite frankly, I prefer the capitals here. That's the S&P standard S&P 500 um, Standard and Poor's measure. So AAA bonds are going to have the highest quality. Means they have the least risk. That means they also have the highest prices. But they are essentially going to be default free. They have the lowest chance of default. As you go down the list, you go to higher and higher risk levels, which means the return that you want to receive goes up. But at the same time, since the return is going up, the prices of the bonds are going down. So everything in this category, these four rankings here, are all referred to as investment grade bonds. Very little chance of default over the long haul, but we have these differences in levels of ultimate credit risk. So each one of these will have, as you go up the list, will have lower and lower returns, higher and higher prices. On the other hand, we can look at what we refer to as speculative bonds, and that's the rest of the rating system. So we go from double B's on down, triple C's on down to D's. And the ones at the very bottom here are essentially very poor investment prospects. They may actually be in default and the companies could be going out of business, but they are the highest risk. That means they'll have the absolute highest return, which means they have the absolute lowest price. Probably not a good investment for most people to think about putting their money into. So quite frankly, most people will invest in the investment grade bonds if they're going to buy bonds at all. So now let's move on then and talk about the yields of these instruments, right? So there's something referred to as the default spread or the credit spread. This is the difference in the yields between corporate bonds and treasury yields. So if you were to look at a yield curve, a curve that illustrates all the returns in the treasury securities, and then look at the average returns of all corporate bonds with different maturities, but let's just say they're AAA rated bonds, they will have a higher curve, right? It will illustrate higher returns than the other yields, the treasury yields, because of credit risk. And the difference between those curves is what's referred to as the default spread. So sovereign bonds, right, issued by other governments, right, we need to understand about this risk level. United States Treasury securities are generally considered to be default free. But what about the debt of other governments? They're not necessarily default free. And certainly any government can print more of its own money. But for instance, Greece defaulted on its outstanding debt just in 2012. And it had a devastating impact on its credit in the global community, but it also had a major influence on its currency and inflation and what you could actually buy with that Greek money. So again, we want to think about this foreign governments. Many of them will have relatively low risk, but we do have to evaluate. The riskiness of the government, the riskiness of the economy of that country. So to end this video, we want to talk about two different other types of yields or ways to view bonds. So the first thing we want to talk about is something called the yield to call. If corporations want to refinance a bond issue, we refer to that as refunding. They can do that as long as it is a callable bond. So in this case, a callable bond says, hey, we'll let you turn this debt in and refinance, but you have to pay X amount of dollars. And the X amount of dollars is referred to as the yield premium. So as interest rates are falling, there's more pressure on businesses to refinance their debt. This yield premium is the cost of that refinancing opportunity. Another way to look at debt is to think of it as being an investment tool to buy something, right? So we want to buy a piece of machinery in 5 years and it costs $50 million. We want to buy some bonds today. We talked about this when we were talking about immunization, so that we have that $50 million when the time comes. So what is the return we're going to earn on our money in that particular investment target and time frame? So here's the bond that we've been talking about here. We have a 9% coupon, required returns 10%, and it has 20 years to maturity. Current price is $900. It has a yield of 10.19. So this is a good bond to buy in today's terms if we wanted to buy it and hold it for 20 years. The yield is more than the required return. So first thing we're going to do, let's talk about the call premium. In 5 years, this bond can be called for $1,090. So how does that affect the return? It says, well, in 5 years, if they actually refinance their debt, I'm going to get $1,090. So my investment that I was hoping for 20 years is now only 5 years. What is that yield that I'm going to get on my money? The yield to maturity of the yield to call, 13.24%. So in this case, we would like them to call in 5 years if they could. That yield is greater than the yield I would get if I'd hold it for 10 years or for 20 years. So the yield to call here is 13.24%. In a later video, we're going to talk about forecasting interest rates. So let's say we forecast our interest rates 10 years into the future, and we predict what the yield is going to be 10 years from now. What will the price be if we know the yield in 10 years from now? We expect the future price to be, in this case, $1,098 in 10 years. What's the yield we're going to get on our money on this investment if we cash it in 10 years? So you notice here we have a 5-year investment, a 10-year investment, 20-year investment. Which is the best? The realized yield to maturity is 11.3%. So if this is an investment, again, we really would like to invest in this because we're going to get 11.3% and we only want 10%. If there's a chance that the company could refinance, that would even be better. We could get about another 2% yield over the next 5 years if they refinance a little bit earlier. So in a later video, we're going to talk a little bit about how we forecast interest rates. I look forward to seeing you in that video.